Good morning and welcome back to the latest edition on the InvestTalk market analysis for the week ending June 13th, 2025. Appreciate you all tuning in to this channel, liking and subscribing, not only to this YouTube channel, but also to our podcast, InvestTalk. Now, this week I am titling the video War Breaks Out Ahead of Volatile Week. And it does promise to be a volatile week, not just because of the headlines about the war in the Middle East, but obviously you had the Fed meeting coming up on Wednesday. Thursday, we have a market holiday, so the market is closed. We have, what else do we have next week? We have option expiration week. So it's going to be very interesting. It's usually a week where there's a lot of kind of markets. I don't say manipulation, but positioning changes due to gamma hedging, unwinds, and adding and rolling to the next month, and all of that that goes on in the options market. So that typically brings volatility. And then you never know what else is next. There's more labor data, which I'll get to in a bit. And that's starting to be worrisome, but a lot to look at as we head into next week. So let's dig into it. Now, here's the weekly heat map, and you see where the sell-off overall was, and it was mainly in the financial sector. You had Visa and Mastercard down over 4% on the week. The Mag 7 was mixed. Nvidia slightly down, Apple down 3%, Meta down 2, Amazon slightly down. Tesla had the best week. Google, Microsoft a bit positive as well, but Oracle definitely the strongest, had good earnings after hours on I think on Thursday. So Friday was a good day, and healthcare did fairly well. So certainly a mixed bag. But what I want to do is pop over here and look at the different sectors. So we're going to look at performance. So here's the 1 week, okay? And then you have 1 year, et cetera. And here are the major indices. You have the Dow down 1%. You have the Nasdaq down, the S&P down about 0.17%. So not a big move there. The dollar was down about 0.5%. Volatility was up overall, and so that was the broader market. But what I want to dig into are the sectors, right? What did the sectors do for the week? And what's interesting here is you had utility strong, you had technology positive on the back of some of those Mag 7 that were positive, as well as Oracle and Tesla being up, but energy up 6.6% on the week. Not a shock there. You had staples down 1%, materials down. You had industrials down 1.6%. So outside of financials, those were the two, and those are more cyclical names, right? Cyclical sectors, certainly weak. You had communication services down as well. So that was the week. We had Bitcoin up slightly, about 0.25% there, and we'll see how Bitcoin handles next week, because it's going to be a very interesting time in markets, and it's still acting more as a risk off asset here, as the current price about 104. And what you can see here is this. Here's a 7-day, right? This is rolled over on the war news. And this is attempting to break out, right? It keeps attempting to break above this kind of 110, 111 level. And if you go back to 1 year here, what you can see is this was back, earlier this year, okay, where we hit high around 106. We pulled back to the mid 70s, and then we attempted to break out. We were consolidating in below those all-time highs for a little bit. Then we broke out, but then we failed, and now we're making a lower high here. So if it breaks the 100,000 mark, I think that'd be very bearish for Bitcoin. But right now we're holding 104, so we'll see how that closes next week. But let's dig into the economic data. You had the CPI number. That was always the big headline. It was about in line with expectations, slight increase year over year, but still kind of in that 2.5% range, above the 2 target for the Fed, but not accelerating to the upside, right? Just kind of roughly flat. Core also about flat, right? Dipped down slightly, but still about 2.75 there. So, in the 2.5 to 2.75 range for CPI. And then the jobs market. I think this is the most important data that was under discussed in a huge way. And that was, initial jobless claims came in for the second week around that 250,000 mark. Now, it's been up there over the past few years, right? This is 2023, so this is about a year and a half ago. It was up, it stayed up there for a little bit, but then fell back down as we closed the year and into last year. And last year we perked up mid-year into these levels, but what you can see is those were kind of one-offs, right? You got to 250, and then you quickly move back into the 225 range. Perked up to 259, and then quickly move back into the 220 range, right? Now we've had two consecutive weeks right at this 248,000 mark, and so it's 2 weeks. It's not then at the end of the world, but this is the real number. Continuous claims. I always talk about this. This initial claim gets the headline. Continuous claims is never talked about, but is far more important. It's about how many people are going on the unemployment doles, and then how many people are coming off of it. How many people are staying on. And what you're seeing here is this breaks 2 million. That is a clear break of the labor market. Okay, this over the past year has really been kind of in this 1.83 to 1.9 million mark. Okay, and fairly steady, right? Similar amount of people kind of coming on unemployment as getting off, and that's about a steady labor market. But now this is in the 1.95 million. This is talking about 50,000 more people now on unemployment than there was just about a month ago, right? And nearly 100,000 more than it was in early April, right? 2 months ago. So if you get above 1.5 or 2 million, this is, I mean, I think this is already broken out, right? You had this testing the top end of this range. Look at this, how it talked about this kind of testing the top end of this range and staying there. That's what happened here, right? We got there in April after Liberation Day, about 1.9. We dipped down a little bit, but quickly got back to the 1.9 level. And in chart parlance, this is consolidation to break out, and that's what you saw here this last week. Now we'll get more data next week, but ultimately this will tell us a lot about what is happening in the labor market. Does it continue to accelerate to the upside, or does this dip back down in the 1.9 range? And then I'd feel more comfortable about the labor market and say this is a one-off kind of week. But I don't see anything anomalous about this last week that would tell me that this is not a breakout. But once again, I think that was underreported and under discussed. PPI on Thursday as well. And this is, I always say this is more important than the CPI because this is the leading indicator to the CPI. This usually feeds in a couple months later into the CPI. And the PPI was roughly flat, a little bit up there. Core PPI, though, did dip down to about 3%. But once again, roughly flat, if you call it kind of in the middle here. So that was not a worrisome sign on inflation. And frankly, I don't think that it's the inflation picture that is a major problem. I think it's more on the labor side. And, with uncertainty around tariffs and talk about tariffs creating uncertainty, but it's a tax increase, right, to the consumer. And ultimately, higher taxes mean less spending. And so I think that is something that what is feeding into the labor market will feed into the economy in the back half of the year. Consumer sentiment on Friday, that was kind of the best data point for this week, still remains well below where we started the year, but a nice bounce back. Obviously, the bounce back in markets certainly help as well. So we'll see if there's a trend there, but that was certainly better than expected. Now, other data, I always talk about this, bank credit. This did break out in April and is trending sideways, but now we got a little tick down last week. Does this roll over is a question, right? It's still kind of in wait and see mode. This is still technically still in this consolidation level around the 4.5% growth year over year of bank credit, which means more liquidity, et cetera. But once again, does this start to look more like end of last year, or do we break out to new year over year highs? We'll see. This is also important as well. This is the Treasury General account. We continue to talk about this, and you get kind of week over week updates. The more this draws down, that is positive for liquidity, but it's temporary liquidity. At some point, they're going to have to refill this, probably when the big beautiful bill passes. We'll see if this gets passed over the next couple of weeks. And then that would raise the debt ceiling and allow the Treasury to go and issue more debt, and that would pull liquidity out of the market. So I think that's another reason why the equity markets are holding up fairly well despite what's happening geopolitically. Is this drawdown of the Treasury General Account, and banks are lending. Liquidity is relatively abundant at the current time, but I'm not so sure that's going to stick into the back half of the year. That's why I'm a bit more cautious as we get deeper into Q3, which we're almost through the second quarter. The Fed week, talked about that next week. They're not going to do anything, right? 0.4% chance they're going to cut rates on Wednesday, so not going to happen. But it's always about prognosticating what the future path of rates will be. And the market basically is pricing in one cut by September. The July cut is low probability, only 23% chance there. But when you come to December, you have roughly two cuts, right? 4.25 to 4.5, and that's kind of the base case right now. So one in September, probably, and then one more maybe in December. But we'll see kind of how the labor market evolves. That could be accelerated. You could get, if the labor market does continue to break out to the downside, shall we say, I think three cuts could be a possibility as well. But there's also some political aspect to this, right? Is how much will this current Fed chair want to help the administration? I think it's clear that they're on pause until there's a lot more clarity in the market. So we'll see. But that is what the market is pricing in so far. Now let's pivot over to the markets right now and go over what is happening on the S&P. We've had this strong bounce. We had a sell-off on Friday. You're getting MACD divergence here, but still haven't broken this 10-day moving average. So it's still overall we're in an uptrend until we break that. I wouldn't say we're having much of an issue. So I think this is fine for now. But obviously, how does this snowball into next week in the Middle East will be a big question. And if you look at something like the NYSE, this tested that breakout area on the weekly chart here. If I go to weekly, all right, and we close below it. So I still think we need to close above it for real bullishness to be kind of take over markets. I still remain kind of neutral because there's a lot of overhead resistance, and the longer it takes for the market to break to the upside, I think the more chance we have of a choppy to bearish second half of the year. And so we're into resistance on the NYSE, a broader index, 2,500 names, and I always think that is certainly most important. Let me get to gold. Gold certainly had a nice week, and that was on the back of the geopolitical concerns. It was threatening a rollover with this MACD divergence, but overall, it's still looking fairly good. The dollar had looked like it was trying to gain some traction this week, but just really couldn't get there. MACD still remains below zero. So the downtrend in the dollar is intact. Now, could it remain in a choppy range for a little while? I think that's certainly a possibility. I don't think the whole dollar being the dollar end of the dollar reserve currency status is I think it's a bit overblown in the short term. I think the long term it's true, but in the short term, it's not going to the global economy can't shift from being so reliant on the dollar to not overnight. It's going to take many years, if not decades. So I still think there's the overvaluation of the dollar is going to remain for some time. But by many accounts, the dollar is overvalued by 30-40%. So if you look at purchasing power parity and things like that, so I don't think the dollar is going to down 30% in a year. I think it's already down 10% in the year. I think it could go down more later in the year, but I think it's going to be more of a period where you're going to get some choppiness and then another breakdown. So I think we're in the choppy period for the dollar. Yen, that's looking strong. Obviously, this is a strong correlation to gold. This continues to look strong. You have stagflation over in Japan, and that means inflation is high, and they're trying to bring it down, and trying to lower interest rates, or lowering interest rates is probably not going to do a whole lot to help that. And so they're going to keep interest rates as high as they can to try to keep inflation contained. And so I still think having a steady yen to a stronger yen is probably likely, which would be obviously bearish for the dollar, and then bullish for gold prices. I'll bring up silver as well. Silver has recently broken out, and I think that is something to take note of as well. Usually, when silver is outperforming gold, that is good for the broader uh, precious metal markets. Let's see if this wants to pull up. Sometimes my charts have been a little funky lately. And see if this wants to pull up. Oh, there we go. See, just had to shift it a little bit. There we go. Silver breaking out this week. So I have no problem being bullish silver. Certainly the chart is looking mighty delicious right now. Let's go look at the VIX, the volatility index that had a nice little breakout on Friday. You did break below the March lows, which I was looking, but we're not below these February lows. So, I would say I'm still modestly bullish on volatility, and obviously that would bring more bearishness to the market as a whole. I want to look at the CLO market. So here is short-term CLOs, JAAA, to what is called SGov. Let's see if this wants to pull up. My chart's still being a little funky. There we go. Wow, quite the volatility on Friday. Let's see if this still wants to be weird to me. It does. Okay. Oh, no, there we go. Got it. So it looks pretty similar, but this kind of gives you that broader trend where it's still lower low, still below the 200-day moving average, and it shows you that the problems in private equity. Let's go look at Apollo. Let's go look at Blackstone. Let's go look at what's the other one? KKR. These are private equity, private credit. These are bearish. These are not looking good, especially, they try to break out over the past week. They failed on Friday. MACD looks bad. It's below the 100-day moving averages. Nothing about these charts tells me good things. So I think this is a big worry, especially with tariffs, with if the labor market's getting weaker, if we are heading into a recession, which I think we are going to see one in the next year. This is an area that could bring systematic problems. And I don't think it's a coincidence that the financial sector is showing signs of weakening, right? So if I run an XLF to the S&P, what is this doing? This is rolling over, okay? And if I look at the broker dealers, that's kind of the strength here. That I would say the broker dealers are not seeing that weakness, but the private credit, private equity arms, alternative asset manager areas are certainly struggling. So I think that tells me a lot about what the market is signaling overall, and you certainly want to take note of that. What are areas that likely are getting a bit of a rebound? I said this last week. I think healthcare is sentiment is pretty bad. I think it can get a bounce. It got a bounce this week. I think that could continue. Now, that is positive for the S&P. And actually, what I want to bring up here is go to Morningstar real quick. And let's go to the S&P. Let me show you this just so you can see the there we go. You can see the weightings of the different sectors and why it's important to look at this based on what if you want to know where the market's going. 33% is technology, okay? 33% is technology. So if you go XLK, which had a pretty decent week, it's threatening a breakout, right? This relative strength is good for the S&P. But it also makes it more vital that technology continues to do well. So that's the most important sector. But then financial services are next, 13%. Consumer cyclicals are 10%. Communication services, so this is a lot of your Googles and Metas of the world. And then healthcare is also right there, about 10%. So those five sectors really drive the market, right? Basic materials, you're talking two, real estate two, energy three, industrial seven, that's okay. Consumer defensive only five, and utilities two, right? So you have those five sectors that make up, if you call this 20 here, you call this 33, that's 53% of the market, 63% of the market, and then 76% of the market, 677, right? So you're talking over three-quarters of the market is driven by those five sectors alone. And then if you go over here, if I bring up XLY, this is kind of relatively weak. Look how this is having trouble making it to those recent highs. Okay, so weak, technology strong, healthcare is rebounding. Okay, and then communication services, let's go to XLC, see what that looks like. And that had a pretty actually rough close to the week, although the relative strength recently is okay. So I'll go neutral with that one, but what's really holding up the market is this technology sector. But the fact that consumer cyclicals and financial services are faltering a bit, I think that's a worry. And if technology falters in any way, I would start to become bearish on this market. So that's really holding up the market. Your oracles of the world. Here's Oracle. Sorry about that. Nice end to the week. And then you had, I'm sorry, Tesla. That had some strength, but you had names like Apple, right? That's relatively weak. Amazon, still not making it to its news highs. Google had a nice little bounce recently, but still nowhere close to its recent high. So I think there's still a lot to worry about in the markets. That's why I remain kind of neutral, even though we're above major moving averages. I think there's just a lot of geopolitical risk. You have option X, and this is a lot of notional value for the June OPEX. It's quarterly OPEX, which means that there's a lot of gamma unwinding happening into next week. And so I think next week promises to be a volatile one. Could be to the upside, but I think you're going to see a lot of news that really pushes markets in both directions. So be ready, be on your toes, and be open-minded. And that's what you have to be in this type of market. I appreciate you all tuning in. And a reminder, the contents of this video are for educational purposes only and should not be considered as a recommendation to buy or sell a security or to participate in investment strategy. The views are my own and do not represent those of KPP Financial or those associated. Hope you have a wonderful weekend.